Hi, everyone. Hi, Catherine.
Very
I always look forward to speaking to you because you truly love data and numbers. And actually, it's wonderful. You've always had this passion, right, for numbers. So let's dive straight in and talk about inflation. If you look at, I know.
Why not? Right.
I mean, we're not going to waste
Nobody's
time. We have
thinking about
14
that,
minutes,
I'm sure. Right.
and we're talking about the UK economy.
Right.
When you look at household inflation expectations,
Right.
you know, compared to the market, to the labor market, what do you worry about the most?
So I worry about inflation expectations more than the labor market, more than the extent to which expectations show up in wages, for example. In the end, when we observe inflation happening in the economy, it comes from firms being able to raise prices. And that's a function of what companies expect to be able to get, and that's a function of what consumers expect that they will be asked to get. So it's really the matching of consumers and businesses on their expectations that I worry about the most in terms of forward-looking inflation. What can temper that goes back to the labor market. As that deteriorates or softens, then people's ability or willingness to spend, to shell out for the restaurant or the shoes or whatever, that can discipline the pricing strategy of firms.
Yeah, you're a little bit of an outlier, right,
Yeah.
in how you see inflation and inflation expectations and what you worry about. How do you explain that?
Well, at first, I look at the data. Inflation expectations at the 1, 2, and 5-year horizons have drifted, and they've been drifting for a while, and that's a part of the persistence. The second reason why I'm convinced that the research associated with the inflation threshold. This is where people become very attentive, not just to food. Everybody is focusing on that right now, the grocery bill and so forth, but they become attentive to the entire portfolio of things that they have in their basket, and that makes them very attentive. And so they're more likely to look at the prices and say, whoa, I'm afraid that that's going to be in the future as well. So that threshold research becomes a very important ingredient in my consideration about persistent inflation.
I mean, how do you describe the UK right now? Again, this is a small open economy. Is it more difficult to understand the complexity than other large economies?
So this is a small open economy, and I think that is an important ingredient. The large economies, our neighbors, you know, the United States and Europe, these are much larger economies. There's a lot more internal competition and a variety of other things that will dampen pricing capacity of firms. And in here, there's less. It's a small place, and that's, you know, shocks internally and labor market conditions internally and competition by businesses internally become a very important part of the inflation process.
But is that why the UK is a slight outlier also in terms of inflation expectations compared to other countries?
Yes, I believe that is part of the story, an important part of the story.
Going forward?
Yes.
How do you see interest rates developing?
How
You're welcome. I don't know if Catherine Mann will answer that.
Right.
But we're trying.
Right. Well, of course, we have a new forecast round coming up. And you know that what I've done in the past, I've chosen to hold rates, as I believe that this inflation persistent scenario that we had as part of our monetary policy report earlier this year, I believe that was viewed as a scenario risk. I believe it is playing out. That doesn't mean I'm completely unattentive to downside demand risks, and I discussed that also, and some of our new our new infrastructure that allows us to combine data in such a way on the activity side, labor markets, GDP components, PMIs, and so forth, that allow us to understand that there is downside risk to activity, there's upside risk to activity, and actually, if you do a forecast and you only have a center point to the distribution, you're going to be wrong, because the data that are coming in using our methodology, our Midas methodology, quantile Midas methodology, it's a bimodal distribution for the prospects for activity going forward. It either could be lower than the center or higher than the center, but the center doesn't have a lot of mass to it.
I like the way you put that. Catherine, I mean, the last time you voted for a cut was in February, so do you think we've loosened too much?
So the cut in February, I think it's important for me to talk about the three different factors that are important in any decision that I make. The first factor, of course, is the prospects for inflation. The second factor is prospects for activity. And the third is whether or not the OIS curve, which is the market, is adequately accounting for the domestic components for the UK economy relative to the spillovers that are, of course, an important part of financial markets in the UK. In February, I had a view that the labor market would loosen much more quickly, and that loosening of the labor market would cascade into lower wage demands, lower pricing power for firms, and so less inflation uptick. And I thought at that time that the financial markets, remember, February was when financial markets were in the US were pricing in 5 cuts, 4 cuts, and I thought this is too loose.
How do you think about the US now?
So right now, I mean, there are a number of different things going on. A little uncertainty, little volatility, and how that's going to cascade into the UK economy through financial markets is something we'll be looking at very carefully over the course of the next 6 months.
I know MPC members and Governor Bailey are very reluctant to talk about what's happening in the U.S. and the Fed, and rightly so. But it's undeniable, right, that it has that the forces of the markets also move expectations in the UK.
So we have a number of different methodological strategies, and I've written about them, and they are both in speeches, charts, and speeches, and the associated methodology in references, so that you can go off and look at it yourself. And it really is, it allows us to decompose movements in the 10-year, movements in the exchange rate, into macroeconomic factors in the U.S., Europe, Japan versus the UK, as well as policy responses, an expectation for policy responses, again, in those various markets. And there are times when we do that decomposition, the UK component is actually pretty small. And that's a time when I think it's important to communicate to the markets, if it's my economy, pay attention to my data.
So where are we now? I mean, is there like a percentage of how much is UK made and internationally made? So
the most recent over the summer was mostly UK made, and that's
government policies.
Well, it's the structure of the UK economy, it's the evolution of inflation expectations, as well as the way policies are being percolated through the economy, especially as we observe how our agents, those are the people out there around the economy who help us understand business conditions and citizens' conditions, and we go and talk to them outside of London, and the decision maker panel, which is the data set that's available on the website.
And outside of London actually is crucial.
Yes,
right? Because
absolutely.
You get a different temperature. It's different if you focus on the capital.
Yes.
Given also the impact of financial services.
Absolutely, absolutely. There is quite a bit of a difference around the UK economy, the various regions and devolved nations. So it's very important to get outside the London bubble.
Catherine, given where we are now, do you see a long pause in interest rates, or could you actually see them go up?
So more than a year ago, I think it was 2 years ago, I talked about the consequences for my monetary policy decision making of something that I called a monetary policy boogie dance. Cut, hike, cut, hold, and I said, this is not what monetary policymakers should do. So that we are where we are, and we, meaning the Monetary Policy Committee as a majority, has made a decision. So for me, I have to use that as where I am. And so for me to hike from here, even if I would prefer, I don't prefer that actually, I prefer a longer hold.
But you said that actually you'd be still ready to vote for a cut if something happened. What do you need to see in the data for, I don't know if it's a boogie dance or to go lower?
Well, you know that my activist strategy is either hold for longer and make a bigger cut when you do, to make it very clear that this is not in response to the financial markets or other things. This is about the UK economy. So it really is a matter of nonlinear adjustment in the labor market. Right now, we are taking some of the heat out of the labor market, so nonlinear adjustment on the labor market side, or a significant change in prospects that firms talk to us about their demand conditions, would be important information for me to communicate that I've seen the materialization of that left-hand hump in our quantile Midas framework for understanding activity.
I'm going to ask you about QT. I'm really spoiling the audience this Wednesday morning. Talk to us about how you were thinking about QT for that September vote.
Okay, so QT is in the background. We're going to make a decision about it once a year, and I think that's appropriate. My main policy instrument is bank rate. However, there are a number of different intersections between bank rate and QT, so you cannot distinguish, you can't devolve or separate the two completely. So, of course, the majority in the MPC voted for 70 billion reduction in the balance sheet through 21 billion of asset sales, and then some roll-off. The executive gets to decide on how to allocate those sales across buckets, short, medium, and long-term buckets. So the MPC decided 70 in majority, with the executive at the time basically saying what we're going to do is 40, 40, 20 in terms of the percentages. So I had a view on both the pace and the tenors. Okay, so the pace, I ended up wanting to have the 62 with keeping the same amount of asset sales. And I also wanted to keep the buckets the same. So why the pace? So as we approach the preferred PMRR, the preferred minimum reserves for banks, we are getting closer and closer to where we're depending on the sterling market facilities that we have in place, the short-term repo and the index long-term repo, and there's another one for NBFIs. And so the closer we get to that, the more we are going to depend on those functioning effectively to have a reserves demand-driven environment so that we'll supply whatever you want. I would like to approach that cautiously. I think we already are closer than most people think to where we start to have to really depend on those facilities. And those facilities have only been ramping up as we have been ramping down on the reserves, on the balance sheet.
So that's the main danger that you're seeing.
That, to me, is the main danger on pace. Now, the tenors, I kept at one-third, one-third, one-third. First, because the most important part of the yield curve is that center part, the medium and short to medium term. It comes through mortgages, it comes through variable rate on bank loans. So those are the most important part of the yield curve, and I didn't want to overburden those parts of the yield curve at this time. I didn't want to tighten that part of the yield curve.
Are we close to neutral rates?
So neutral rates have three different elements to them. I talked about this in the Bank Watchers Conference. There's inflation drift. Yeah. There's the nominal interest rate relative to neutral nominal. And both of those two are key to determine how close we are to the real neutral. All three of those have a little bit of uncertainty about them. So we are closer to neutral than some people think. It depends on whether you're in the financial markets or whether you're perhaps thinking about a different time frame. People who think about neutral rates in their long-term structural foundations, demographics, productivity growth, that's a 10-year horizon. For me, that's way off stage. It's interesting, but it's way off stage. So I'm much more focused on the issues that face me in the monetary policy horizon. And with that regard, some of the factors that I think are most important is to think about volatility and inflation. Volatility in inflation is associated with an upward bias to the inflation rate because of the way downward rigidity in labor pricing and product pricing. So you've got higher volatility in inflation, you've got high inflation. Both of those yield upward bias to inflation. So that says something to me about the policy rate nominal policy rate today.
I know you don't like personal questions, so I'm going to ask them anyway, because you're a relentless economist. You love data. You're not afraid of speaking up, even if everyone else, thinks otherwise. Like, what made you the economist you are today? And it's very different, I imagine, working for, a central bank than it was in private.
Okay. So I started working with data when I was in high school, and I was asked to collect data on housing markets for Data Resources. It was the first econometric forecasting firm headed up by Professor Otto Eckstein at Harvard. And
so you're 16 at this point. 15,
yeah, I was a babysitter, and then I turned into a data scientist. Only it was copying things out on paper with a pencil. But I think the point here is that it was to understand housing prices, and this was 1970. So what goes around comes around. It's always, and then I've just stuck with data ever since.
Because it gives you, I guess it's honest.
Well, well, you can always interpret it differently, but it is what it is, right? Right.
Catherine Mann, thank you so much for joining us today. Thank you.
Thank you.